You've been searching for the best way to generate passive income in your life and heard that real estate is a great way to do it. But you're tired of all the so-called gurus who are all talk and no substance. Get ready to celebrate because Kevin Bupp has spent 14 years successfully making it happen. This is the Real Estate Investing for Cashflow podcast. Now, here's Kevin Bupp.
Hey guys, Kevin Bupp here. I want to welcome you to another episode of the Real Estate Investing for Cashflow podcast. Our mission is to help you build and maintain massive amounts of cash flow through income-producing real estate investments. Our guest for this week's show is cost segregation expert Kimberly Lochridge. Kimberly is the Executive Vice President for Engineered Tax Services, Inc., an industry-leading provider of specialty tax services in the United States. Kimberly possesses a powerful combination of real-world business management skills with a fundamental understanding and practical application of tax codes as it relates to real estate and energy efficiency incentives. This knowledge and experience has uniquely positioned her as a big league tax expert for Fortune 500, high net worth individuals, ultra high net worth individuals, single family and multifamily offices, architects, engineers, and CPAs worldwide. In addition to her role as EVP at Engineered Tax Services, Kimberly also serves on the investment counsel for a private family office where she reviews potential opportunities and co-investments for the family's portfolio. This activity has earned her a seat on the tax committee for the Washington, D.C.-based Real Estate Roundtable Group, as well as a variety of board positions. So, guys, I'm very excited to have a candid conversation with Kimberly about a variety of topics revolving around the power of utilizing cost seg studies as part of your real estate tax planning strategies. And I'm absolutely confident you guys will find huge value in our time together. Additionally, I added a little bonus surprise for you guys. Our very own Brian Spear is going to be joining us today as well. And you might ask, in case you haven't talked to us here at Sunrise, who is Brian? Well, Brian's actually my business partner, and he's the co-founding principal here at our investment firm, Sunrise Capital Investors. And when I made the mention that we were going to be discussing cost seg studies in the show, the excitement in his face was uncanny. And so he's a huge proponent of this powerful tax strategy. And so he definitely wanted to be a part of this. And he actually spearheaded the multiple cost segregation studies that we had completed on our numerous mobile home parks that we own. And so he's going to share the details of what this process looked like for us and also the incredible benefits that came as a result. And as a free gift to you guys, and just because he's such a generous person at heart, Brian's going to share with you our recent cost seg study for one of our mobile home parks in Iowa. So it's going to be in the show notes for you guys to download and review. So listen in, and we've got some great details we're going to share with you guys. And so with that, before we roll on to the show with Kimberly and Brian, I just want to make a mention of the free 30-minute call that we've been offering each and every Friday. I open up 4 different time slots for you guys to have a call with me, a strategy session. No ulterior motives. I'm not going to try to pitch you a coaching program or try to sell you anything. This is just a way for me to connect with our listeners and a way for me to give back and pay it forward. And if you'd like to schedule that call with me, go to my website, kevinbupp.com. Go down to the bottom right-hand corner. There's a button that says schedule a call with Kevin. Go ahead and click that, pick a time off my calendar, and make sure you put some notes in there about what you'd like to chat about during that time together. And I look forward to connecting with you. Now, guys, without further ado, I'd like to welcome our 2 guests for today's show, Kimberly Lochridge and Brian Spear. Guys, how you doing today?
Really good. Hi, guys. I'm glad to be here. Thank you for the opportunity.
Yeah, life is good, Kev. Never had a bad day in my life, so just excited to be back on with you, man.
Yeah. Always looking forward to it. I was excited about this show today, guys. I know that this has been kind of a buzz around our office here over the past few months with these cost seg studies that Kimberly do for us on our numerous mobile home parks throughout the country. And so, Brian, we've been trying to get a topic going on this, our show on this topic here now for many, many months. And so just real excited to be here and excited to have Kimberly's expertise, on the show and share with our listeners. And so with that, Kim, what I love to do is maybe just take a few minutes for the folks that aren't familiar with you and your background. Take a few minutes and tell us a little bit more about who you are and how you got into this space.
Yeah, it's a great story, and I'll abbreviate it a little bit. I've been an entrepreneur since I was in my teens. Pretty much my whole beginning of my career was starting businesses and running businesses, acquiring and selling, merging, whatever it took. And, I found the owner of this company through multiple friends of friends or acquaintances. And I was on the board of a big manufacturing company down in Southern California for energy efficiency products. And there was these tax incentives. And, I just continued to follow it to find someone who was an expert in the field and continued on and lo and behold, I ended up going to work for the company that on a subcontractor basis since I was an entrepreneur, but ultimately it morphed into something so much more, and I'm really happy it has. So I've been with ETS for about 10 years. My background is in finance, accounting, and tax my whole life. So it's been a big part of my excitement. I was always really good at math, but I hated it. And it wasn't until they actually put dollar signs in front of some of those figures that I got really, really excited. And I knew what my calling was. And that was in accounting, as geeky as that is. So that was a lot of fun for me. And I've been doing it ever since. It's just been what I focus on. So I'm here, and now we're doing specialty tax and really on a high level educating so many property owners and real estate owners in every sector about the benefits of cost segregation and other tax incentives that are available.
Yeah, fantastic. I appreciate you sharing that. And I know that we were introduced initially by our CFO, who had gone out and vetted many different servicers as it relates to cost seg studies. And ultimately, we found you, and very happy that we did. And again, you worked with us on a number of projects now. And it's something that, Brian, you actually spearheaded. I mean, you saw these efforts on the front end of working through these cost seg studies with Marcus, our CFO, and also Kimberly and her team. And so with that, Brian, I'm going to kind of pass it to you, being that, again, you were the kind of the leader in charge of running the cost seg efforts. And so I'll let you take it, Bud, with sharing the details on the background of kind of our process, our experience, and ultimately the benefits that came out of it.
Yeah, very briefly, the process was as follows. We looped in the entire finance department to do our best to vet as many different companies as we possibly could find. We're in a unique niche, manufactured housing. And while there are a lot of different companies who handle cost segregation studies, there are a select few that I wouldn't say specialize in manufactured housing, but have a good amount of experience in the niche and have been able to provide really high quality results for the partners in that space. Ultimately, when we began to narrow the field to folks that had experience in manufactured housing and then whittle down to the specific criteria as to why we'd like to work with one individual, it became about how granular the detail is inside of the actual report. And really, Kim over at ETS just blew everybody else away in terms of the amount of actual detail provided in the final product, which will provide significant dividends down the road. And we'll go on to discuss kind of how that can benefit all the investors that choose to go down this path. But very first, at the very high level, what I'd love to do, Kim, if you could, the vast majority of our folks are very familiar with cost segregation studies, but if you could give just a couple of brief seconds to overview what a cost segregation study is, it'd be very, very much appreciated.
Yeah, for those who don't understand or don't know what cost segregation is, it's just a different method of accounting, essentially. So it's a different method of accounting when it comes to accounting for your real estate. If you think of the filing a tax form, most people know what a 1040 EZ is. If you're younger and you're in the just have a job and you don't own anything and you don't really have kids or anything, you just very simple can file your tax return on a 1040 EZ and take your standard deductions. As you get older and you develop a portfolio, you may have a 401k, you have kids, you got a house with mortgage, those types of things, you tend to morph over to a 1040, which is a more complex form. And typically, most people will have a CPA involved in filing their taxes so they can itemize their deductions. So the difference between a 1040 and a 1040 EZ is that the EZ is the straight line, or what you call the standard deductions, and your 1040 is the itemized deductions. Well, cost seg is the 1040 for real estate. It's where we itemize the deductions instead of just taking straight line depreciation, which is, in this case, if you have a mobile home park, you buy it for $1 million, you have to depreciate that $1 million over, 27 and a half years. So it's really one of those things where you have a choice. Both ways are legal. Both ways are available to you. It's just that filing the itemized deduction or the cost seg, you have to have a professional help you, just like you have a CPA help you with a 1040. So it's a little more complex. Essentially, what we're doing is we go into the park or the building, whatever it is, we break down all the different components. In the case of a mobile home park, we're going to break out the components of the utilities under the ground, the site improvements, the driveways, the walkways, the curbing, the gutters, the landscaping. Each of the homes, right, is part of the park. Usually in some cases you own them, some cases you don't. It could be common areas like a pool or a laundry facility or an office. We break down all the components to everything that's on that building. And as a result, the IRS allows us to take certain components and we get to capitalize or depreciate them in faster buckets, faster class lives. So there's like a 5-year bucket, there's a 15-year bucket, and then what's remaining is a 27.5-year bucket. So it really helps decrease the tax liability if you have more depreciation. And that's essentially what cost segregation is.
Yeah, that's absolutely phenomenal. And with the advent of the Tax Cuts and Jobs Act, which was recently passed under the Trump administration, a lot of that shorter lived property, 5, 7, 15-year property, can be depreciated all the way down via bonus depreciation in year 1, which is absolutely phenomenal. So all the investors out there that are contemplating this, who may be wondering if it's beneficial, I think everybody on this call knows just how beneficial these cost segregation studies can be. But there are going to be some skeptics out there. And for the skeptics out there, I'd love to just kind of walk through some of those biggest myths associated with cost segregation studies in general. Kim has some experience in this and would love you just to speak to some of these more frequently asked questions. The first being, if I were to do a cost segregation study, I just give it all back when I sell. So that is an objection that you often hear. If I'm going to do a cost segregation study, why would I do that? I simply have to repay that depreciation immediately upon disposition anyway. So why would I go about doing it? Could you dispel that myth for us?
Yeah, so let's talk about that. It's kind of interesting, and I want to touch on the point of recapture for those that don't really understand how that works. Essentially, when you sell a building, you're taking what you sold it for minus whatever the purchase price was, which is your gain, but you also have to add into that gain your accumulated depreciation. So the myth is that if you accelerate depreciation and take it faster, you're accumulating it faster, which means that you're going to have to give it back more when you sell. That's the myth. Part of that is true, except for the fact that as you whittle this down into the actual math, what's happening is it's multiple headed here. The first thing, and this is the biggest, in my opinion, when you take the benefits of cost segregation, that means you're accelerating the depreciation and taking more depreciation against the income and therefore paying less tax. You are taking that at ordinary tax rates. So the ordinary tax rates, could be, if you're in California, it could be 50%, 53% or 54% at the top level of combined state and federal tax. If you're in a state that doesn't have state tax, you could be at a 37% top tax rate, or maybe scale it down to 33%. Depends on where you land, but that's what you need to find out. So you figure that out first. What's your ordinary tax rate? And then if you turn around and you get to take those benefits off of your ordinary rate, so you're getting that nice deduction there at a high tax rate. When you sell a property, you're only paying capital gains tax, which is 20 to 25% depending on your structure. So it's a simple math of coupon cutting. Essentially, you're getting it at ordinary tax rates, you're giving it back at a lower rate. And so you still have some recapture to pay, but it is minimal. It's minimized compared to what it is. So that's one. Another reason is, especially if you're going in and doing any kind of improvements to this park or your real estate, there is a huge opportunity for cost segregation, because one thing so even if you're going to have it for a small period of time, let's say you're only going to own it for 5 years, you're going to get in, do some improvements, stabilize it, get it to where it's performing, and turn around and sell it. Let's say that's your plan. If you're doing these improvements, here's the math of the accounting. You purchase it for $1 million. Say you put $1 million into it, you sell it for $2.5 million. So you're making $500,000. When you depreciate the $1 million, then you have to depreciate the $1 million in your improvements, right? So now you have $2 million that you're starting to depreciate at different dates. And what happens in the improvements is that a lot of the assets that you had in the purchase are being removed from the property. You could be tearing out the concrete or the paving. You could be taking out old facilities and putting in new, or remodeling, or old mobile homes, right? Let's say there's a lot of park-owned homes that you're going to dispose of or sell them or renovate them or whatever you're doing. You want to get that depreciation off the books as it's being removed from the property, because otherwise you're going to double depreciate two assets, one of which doesn't exist. So let me put it to you this way. So you have the first $1 million on the depreciation, you're accumulating depreciation, right? And then you're accumulating depreciation on the improvements. If you can retire off and get out of the books, out of that first $1 million, you're actually not going to be accumulating depreciation, which is going to minimize your recapture. You can't take that retirement, it's called partial asset disposition. You can't calculate it and you can't take it unless you know what it is, and you have to have that breakdown, which is the cost segregation study. So it's extremely valuable, not only in your initial purchase to have your basis set for the depreciation, but also if you're ever planning on doing improvements, repairs, renovations, retrofits, anything like that, that you're taking off the old assets and removing them from the books in order to minimize the recapture that you have to pay on the backside when you sell.
Agreed. And that second myth of having cost segregations not work on short-term holds is the one that I would say even more experienced investors don't fully comprehend, because they're not truly taking advantage of that partial asset disposition. And again, the reason that we decided to move forward with your organization was that you get really granular on each individual aspect within the community or within the property, so that we can take those individual assets off of the balance sheet as we add further CapEx throughout the entirety of the hold period. That's going to pay significant dividends down the road once we ultimately do dispose of that asset, because it limits the depreciation and recapture so dramatically. And that is really one thing that I'd like to highlight, guys, as we roll through this and we dig a little bit deeper into the case study. That partial asset disposition, it's paramount that you're maintaining that appropriately as you continue to hold that asset for throughout the entire hold period. The next piece of this that I really wanted to touch on prior to getting into the case study, Kim, was another myth, and that cost segregations just in general are only for larger assets and they're too expensive. What would you say to those individuals who feel that, cost segregation studies should only be done on significantly larger assets and that they're just too small or too expensive when you're dealing with much smaller properties?
Yeah, so I do cost segregation studies on little mom and pop ice cream shops, and it absolutely pans out. I do a tremendous amount of single family homes for people who own vacation rentals under Airbnbs or something like that. There isn't a property that's too small. There's no threshold by the IRS that says, that this is where you can do it and what you can't. But sometimes it's not cost effective to do that. There are different types of cost segregation studies. And as you dig into this, you'll have engineered based cost segregation. And that's where we actually rebuild that property from the ground up. Everything from the utilities underground to foundation to roofs to light switch plate covers on the wall. Everything is broken out in an engineered based study. You don't necessarily have to have an engineered based study, but the bigger the property is and the more dollars you're dealing with, the better it is to substantiate those. So we have different levels of cost segregation that we can offer, and I'm happy to help anyone who's interested to be able to identify what level is best for them. If you are going to hold a property for a couple of years, you're not doing, substantial rehab, you're going to get out for whatever reason, which usually doesn't make sense. But if it happens, it may behoove them to do a smaller limited scope type study, which we can get the cost down lower. So, it really, I've had so many people be told by maybe a larger CPA firm that it doesn't make sense unless it's $10 million of basis or more, something like that. And that's because if a CPA is going to do it, they have to outsource to an engineer and they have their billable hours. It's very expensive and it just doesn't pan out economically. But where we have this set, where we're a specialist in this, it makes a lot of sense to bring us in because we have more expertise and we do have these different levels. One analogy that I like to make that makes a lot of sense to many people is that I think of the CPA as the family practice doctor and ETS is the brain surgeon. So we come in and do the brain surgery, and just like you wouldn't go to your brain surgeon for the flu, you really don't want to have your family practice doctor performing brain surgery on you, right? It's a specialty. But you do want the collaboration. You want your medical team in place, right? You want to have your brain surgeon communicating with your family practice doctor to tell them what types of medication you've been on all these years and what other problems you've been having, because all that could be linked and could be really good information. Well, that analogy is no different when you're dealing with a cost segregation study. You really want to have your brain surgeon or your cost seg expert to be able to work hand in hand with your CPA or your family practice doctor in a medical team for your best benefit. I can't tell you how many times I've had somebody go out and have a bright idea to do a cost seg study, and they come back after it's done and they take it to their CPA, and the CPA says, I don't know why you wasted the money on this. You can't utilize it. You can't benefit from this. And it turns out that they were a passive investor. They didn't have any other properties, and they can't offset their W-2 wages, and so they ended up getting stuck. I never want to talk to somebody and be in that position where I have to tell them you have to still pay for the study because we did the work. So that's a perfect example of making sure that your medical team is in place. There's no cost to do a benefit analysis to make sure that this is going to be a good fit for you. But it is really important that you have that package of people to look out for your best interests. And it's just highly recommended.
Hey guys, Kevin Bupp here with Sunrise Capital Investors. As you are hopefully already well aware if you've been a listener for any period of time, my goal has always been to provide you with as much value as I possibly can through my two podcasts, Real Estate Investing for Cashflow and the Mobile Home Park Investing Podcast. As our audience continues to grow, literally, we've been downloaded millions of times by folks in over 125 countries. I've had thousands of people reach out looking to get involved in our niche. And that's the phenomenal niche of mobile home park investing. For those that don't know, I've been a full-time real estate investor for nearly 20 years now, and I've personally invested in and have owned apartment complexes, various commercial properties, hundreds of single-family rentals, and I've interviewed some of the most successful investors in just about every other asset class, and I've arrived at this one very simple conclusion. Mobile home parks are hands down the best investment I've found to date. Why? They provide investors with the best risk-adjusted returns out of any other real estate sector that I've seen. Investing in real estate can get complicated, and I really want to simplify this process for you. If you're someone who wants to diversify away from the uncertainty of Wall Street and allocate a percentage of your real estate portfolio to mobile home parks, but maybe you don't have the time nor the inclination to personally locate good deals yourself, then our team will do it for you. At Sunrise Capital Investors, our team specializes in the acquisitions and management of undervalued and highly profitable mobile home parks. And we are now providing accredited investors with an opportunity to participate directly alongside our team in our up-and-coming deals. And let me say this, I believe that we are hands down the best in our space at sourcing highly profitable off-market deals. That's really what makes us unique in this niche and as investment managers. As stewards of your capital, we truly are aligned with our investors. We've structured our investment fund so that we as a company are incentivized in the same way the investor is, which is through the performance of the investment itself. In addition, we want to make sure that we not only make money for our investors, but that they understand how it's being made. That's why we provide our accredited partners with a private monthly podcast that walks them through the detailed updates on how their investment is performing. And we're very transparent, providing you with the good, the bad, and the ugly at times. And so if you'd like to learn more about the partnership opportunities with our team here at Sunrise, please go visit sunrisecapitalinvestors.com and click on the investors link to get signed up. It's absolutely free and you'll get placed on the priority list of when new opportunities come along. Also, feel free to call us at 833-CASHFLOW without the O. Again, that's 833-CASHFLOW without the O. And one of our investor relations team members will help you schedule an appointment to speak with one of our managing principals. If you have questions, go ahead and schedule a call and let's get on the phone and talk. And with that, guys, I like to leave with one last thought. From the time that I wake up in the morning till the time that I lay my head down the rest of the evening, my number one priority with everything I do, whether it be recording this podcast, working for our investors, helping each of you reach your investment goals, to providing a great experience to each of our residents who reside in our communities, is to add huge amounts of value to everyone that I come in contact with. Now, with that being said, I look forward to the opportunity of bringing value to you through Sunrise and through this podcast. Thank you for your time. Now, let's go ahead and get back to the show.
Yeah, I couldn't agree more. And it's a testament to your organization that when you move forward with any particular individual, it's a study that you're willing to spend additional time with our finance department, not only today, it's not a one-time transaction, but years down the road. If and when we add additional capital expenditures into a given asset, we can always jump back on the horn with Kim and the rest of the team over at ETS to walk through the finer aspects of the depreciation recapture to make sure that we're handling the balance sheet accordingly, not only today, but years down the road. And it's very much appreciated to go that extra mile for customers, Kim. It's appreciated.
Thank you, Brian.
One thing that I would really love to do now is kind of pivot onto the case study and give a real world example of one of the deals that we actually just acquired in the third or fourth quarter of last year. It was a deal upon which we decided to do a cost segregation study. And for everybody that's listening in here, I know that there's no video, so bear with us as we do our best to paint you a picture of the results. But Kim, if you would be so kind to pop open the Waverly results, and I'd love to highlight three specific things. The very first piece would be page 17, the summary page. And again, guys, we're going to provide a link to this in the show notes, so feel free to click that. Go ahead and get the report for yourselves so you can follow through and follow along with us as we discuss this. But let's pop open the summary page and just kind of give a high-level overview of what this page is and try to make a little bit of sense of it for the listeners out there.
Yeah, this one's a little scary to start with because there are so many numbers on this page, but it really isn't as complicated as it looks. It's just that we tend to provide more information than you probably need. The most important part of this page for those of you who have it pulled up or who want to go back would be the upper left-hand corner, which talks about the property, the purchase price. We extract the land value, and then we land on the actual basis, which is the start of our depreciation number. In that case, this basis for starting the study is $1.1 million for ease of discussions. We don't have to get into detail of the numbers, but $1.1 million. So basically, when we do our study, we're going to go in and we're going to rebuild that property from the ground up, pretend like it's just dirt. And what is it going to take to get it to what it is today? If something would happen and it just disappeared, what would it take to recreate this particular property? And in the column D, which is the kind of in the middle of the page on the left, it shows that a replacement cost of, if we had to do this from the ground up, it'd be $5.8 million, which is quite a bit more than what was paid for it. So we have a problem that we have to scale that back down and keep the integrity of the breakout of the cost seg study. So we're breaking out, just like I said before, we're breaking out everything from the foundations to the concrete, the masonry, the metals, the openings, the windows, the doors of any of the properties that are any of the homes that are park owned, HVAC systems, plumbing, and any common areas. All of that is broken out in detail. And that kind of shows where each one belongs in what category. And then from there, we actually scale that down through a series of tax passes and tolerance passes and tax factors. And we land on the results, keeping the integrity of the breakout of the original replacement cost. And that's really important for the IRS. So the results in this case are in columns L, O, and R. And ultimately what happened was 1.15% of this, which not very many park-owned homes, if I remember correctly, hardly any, but 1.15% ended up in a 5-year classification, okay? So that's not a lot. It's minimal. It was about $13,000. And then in 15-year property, which is mostly landscape, gutters, roads, utilities, pads, all the stuff that services each of the lots, that ended up being 97.24%. Now, between 97% and 1%, you're almost the entire property in this 1.1 million or 1.3 million. So this ultimately this was much higher. I don't want everyone to expect that. Usually in mobile home parks, we see 50 to 80%. Sunrise ended up performing very, very well. So whatever they did on most of their properties came out really nice. And then the rest of it, which is like another 1%, it's 1.6% actually stays in 27.5 year. And that's what's required by the IRS to go into those buckets. So out of 100% of the building, about 97% went into 15-year instead of 27.5 year, which was huge, huge benefits. Now, take it one step further if you want to talk about bonus. I want to jump in
very quickly here to make sure that the listeners comprehend and understand the entirety of the capital costs. So when we go in and we begin the cost segregation study, one of the first things that your provider is going to ask you is how much of that purchase price and how much of that capitalized cost is attributable to the land value. That is a decision that you'll have to make internally and provide them with. So when she's conveying that, 97%, if you will, of the asset is attributable to 15-year property, that is the piece of the capitalized cost excluding the land. So we went ahead and said 20% of this total capitalized cost is attributable to land. 80% is attributable to the rest of the acquisition, all of the building and improvements, if you will. Of that 80%, roughly 97% of that 80% was attributable to 15-year property.
Correct, because land's not depreciable. Yep.
Indeed. So that's a really high-level overview of the summary page, guys. And I know that we're getting a little bit more granular, but I want to make sure that we're providing as much value as possible to the investors out there. I don't often see folks get this detailed. And with Kim on the line, I'd love to provide a little bit more, again, a little more specificity. If we were to drill down to page 25 to 36, that's really where the rubber meets the road and really where the true value in the cost segregation study lies. So Kim, if you would be so kind as to drop down there and kind of walk through the asset summary and detail and give us kind of an overview of what that looks like and how the partners can benefit from that, it'd be very much appreciated.
Yeah, I think someone might look at that previous summary page on page 17 and think that that's the study and that's the detail because there's a lot of information on that page. But really, every line item on that page has, a multitude of more line items that back up that documentation. And part of that is for audit defense. We want to make sure that if this is ever questioned by the IRS, that it's substantiated and backed up by actual numbers that the IRS approves. And that's how we are able to offer audit defense and be able to defend these things and stand behind them because this is based in science. First, all the breakdowns, and then therefore it's compared against what the RS means or the IRS approved pricing guide is. So it's really important and it's super detailed. A lot of times people think by doing this, you're actually going to get in more trouble by the IRS, but it's just the opposite. You really do have more substantiation. There's no question because it's all based in science. So starting on that page 26, this is the full-on detail. I actually tell people that this is the Bible for their building. This is what breaks out every plumbing elbow and every lineal foot of electrical that goes and services each, lot. It's pretty incredible. And if you just scroll through, it gives you a detail of the asset detail of, like I'll read you one, the pipe copper tubing, 1/2-inch diameter, type L, includes the coupling and clevis hanger assembly, 10 feet, this is the detail. That's one line item. And it tells you that this particular item belongs in a 27.5-year class life, how many quantity there is, and the unit, whether it's lineal foot, square foot, or per piece. Then it also has the unit price. And so it multiplies that, obviously. Now, this is, some people would look at this and say this is overkill. But I'll tell you what, when you're doing any kind of improvements and you have the ability to say, hey, in each one of these homes, there's going to be this and this and this, and you know how much you take out, even if you can guess, there's a big benefit in being able to write those assets off, and they add up. Plus, it's all substantiated. So if the IRS ever questions what you wrote off, you have the backup documentation. So not only is this going to benefit you by giving you your initial basis of how to depreciate this property that you just bought, but also in the event of doing improvements, you'll know where to put it back on the depreciation schedule without having to have another study. You know, if it's a restroom wall lavatory, it's hung on the wall, that's a 27.5-year class life, and you know that has to be put back in 27.5 years. This, of course, I want to preface it with, this is only the assets that will be capitalized. This doesn't have anything to do with the things that you're able to expense during renovation. But if you're doing a pretty substantial rehab that you have to capitalize the improvements, you're absolutely going to want to use this report and reconcile it against the invoices for that tax year. You can only take your partial asset disposition, that is the write-off of the assets that are removed, in the current tax year. So if you do improvements and you start demoing in 2019 and you're doing a bunch of improvements and they land in 2020 and you don't go back and take your partial asset disposition, you lose it forever. You really have to have it off the books, get it out of there, get it off there so that you don't have to pay recapture on it when you do sell in, say, 5 or 10 years. Very, very important to have this detail.
Agreed. Very, very important to have this detail. And for those investors, specifically in multifamily or a litany of other niches, when working with a third-party property management company, you need to ensure that they have this information at the ready so that when they do those capital expenditures and do those capital improvements on your behalf, they're actually handling the depreciation appropriately. It's vital to have all the different surgeons, if you will, all the different pieces of your respective team working together cohesively to ensure that you're providing the best below the line return that you could possibly provide to your partners. Again, we've already discussed how imperative it is, and this is just a further example to make sure that with a litany of different people that are touching the asset, that they all need to be speaking the same language. So please just make sure that you're keeping everybody in the loop, and so the right hand knows what the left hand is doing. But the partial asset disposition is not the only piece that is extremely powerful in this report, amongst others, right? There's so many different things that are phenomenal. But one I'd like to highlight is on page 50, the DEERA report, which stands for, it's an acronym for Detailed Engineering Insurance Replacement Appraisal. Kim, could you walk through the DEERA report? Again, that's on page 50, and convey why that is an important piece of the study and how our partners or investors can benefit from a DEERA report.
Yeah, and I'm sure if you haven't already, you probably have done a similar call with insurance people on how to insure mobile home parks, because that's another area that you really want to have an insurance carrier that has expertise in mobile home parks, because they are definitely unique. This is a very interesting case, and a DEERA report is very beneficial for anyone who owns real estate. So you buy a property, you call your insurance company to get quotes. What is the exterior? How many square feet? What is the type of building? What's in it? You know, they ask you all these questions and they plug it into their software and it spits out a number of what the coverage should be or the replacement cost. Most people really rely on their insurance people to tell them what the replacement cost is. But what's really interesting and common sense is that the higher that replacement cost is, the higher the premiums you pay. So what we try to make this a little bit easier, and a DEERA report is essentially a third-party engineered-based appraisal that is for replacement costs specifically. And what it's used for is insurance purposes. Typically in insurance policies, they don't cover certain things under the ground. The majority of a mobile home park, the value is under the ground and in concrete and the pads and the earthwork and the, exterior type improvements. Insurance companies usually don't cover that because if you think about it, in a natural disaster, if you have a fire, you still have those assets under the ground. And if you have a flood, they're still there. They're usually not going to be washed away. So they don't really cover those, but they don't want you to know that. So really, typically what we do is take their entire replacement cost, and not all cost seg studies are going to provide this because it depends on the method of which they're approaching it. In this case, we're doing a replacement evaluation and to get the benefits of the cost seg study, and as a result, we can provide this DEERA report. So in this particular case, obviously I had mentioned that the replacement cost of Waverly was $5.8 million. And ironically enough, unless you have special endorsements or riders on your insurance policy, we evaluated that $5.7 million of the 5.8 is not going to be covered under insurance. That means it only leaves about $100,000 worth of assets that'll be covered. Now, if you're a mobile home park owner, you will probably go to an insurance company and make sure that you have a little bit better coverage. But it's going to be very difficult and probably really expensive. And Brian and Kevin, you can probably speak to this on how you do it, but your typical insurance policy isn't going to cover those things. So we break it out and we give it to you. And then that way, let's say, they bought this, they paid $1.1 million. Who knows what the insurance company would want to cover it for? But now they have this guide that says, we don't want to be underinsured, but we don't want to be overinsured either. And if the insurance policy isn't going to cover certain things, we want to make sure and extract that. So these reports become a starting conversation piece with your insurance company. In my mind, I call the insurance company part of your medical team. They're just another component of that. Maybe they're your insurance company, your health insurance, right? That talks to what's going to be covered if I do this brain surgery, what's not, and those types of things. So I just want to point it out because this can also be extremely valuable to have this as a conversation piece when getting your insurance coverage.
Agreed. Thanks for going into that level of detail. It really is another beautiful aspect of the cost segregation studies that you guys provided. And again, not everybody does that. So it's these reports by themselves often cost several $1,000s. So looping it into the cost segregation study, it's a very nice add-on, and it's again much appreciated. Pivoting on, I don't know where to go from that, Kev. I was just going to kind of do a brief case study here on what a hypothetical $1 million deal would look like. I mean, you want to run through that or?
No, go for it, bud.
All right. So with all that phenomenal information that can be provided to us by using those cost segregation studies that Kim just outlined, I'd love to just very briefly walk through a hypothetical example of what that really means to an investor. How does that actually impact me once we move through the cost segregation study and implement all the different benefits that are associated with that process? How does it impact me personally once I actually go to file taxes and write off that depreciation? Again, with the unique aspects of the Tax Cuts and Jobs Act that was just passed recently, the vast majority of the shorter lived property, again, can be written off in year one. I'm going to run through a hypothetical in manufactured housing, which again skews the numbers a little bit because manufactured housing, mobile home parks are just remarkably tax efficient. But for ease of reference here, I'm going to use our niche. So, for example, using simple numbers, if we were going to go in and buy a mobile home park with an all-in capitalized cost of $1 million, and we use the same exact sort of statistics that we just outlined in Waverly, where roughly 78% of the total capitalized cost is attributable to shorter lived assets, then we can write off roughly 78%, again, easy numbers here, of that given asset in year one. Let's assume for ease of reference that it's only 70% of the asset that is attributable to shorter lived assets. So of $1 million property, we can write off $700,000 in year one. And again, assuming it's a $1 million acquisition, let's assume that there's 35% that we would have to be all in on in terms of the down payment, the capital expenditures at acquisition, as well as the working capital that we need to put into the deal. So we're into it for $350,000, and we get to write off on year one, $700,000. So again, on our K1, what are we going to see? We're going to see a $350,000 investment into the property, and we're going to see a loss on our K1 of $700,000. To some, that may be less impactful, but for those extremely high net worth earners or high income earners who can repurpose that loss and allocate it against other earnings. If you're a very, very high earning professional, a doctor that earns 7 figures per year, and you just happen to have your wife who is a real estate professional, and she went ahead and bought this property on your behalf, you could use that passive loss of $700,000 to offset your earned income of $1 million. And again, rolling out the top tax bracket of whatever that is, 37%, or in California, if you're adding in state tax, it could be upwards of 50%. That creates a significant, meaningful impact to your bottom line. Again, all in the first year. So even without taking into account any of the cash-on-cash return that's actually generated by the property, without taking into account any of the principal pay down or equity buildup or sweat equity that you're going to create in that respective asset, talking exclusively about the tax benefit that you can garner from utilizing a cost segregation study appropriately, you can literally save tens of thousands, if not hundreds of thousands of dollars below the bottom line if you have sufficient income to offset via other real estate and or other income if you're a real estate professional. So really, really high quality stuff, and definitely something that you want to have in your pocket if and when you are seeking tax efficient investment vehicle. But that's really all that I wanted to dig into, Kevin. Would you like to grab the ball and run with it there, bud?
Yeah. I just want to kind of wrap it up here, guys, and just thank you both for covering this, very important topic. You went into an incredible amount of granular detail, and I'm absolutely confident that the listeners are going to walk away with a great deal of value, especially if they go download the example, the case study that we shared that Kimberly went into regarding our Waverly Mobile Home Park in Iowa. Again, guys, just a reminder, you can go download a copy of that. We'll have a link to it in the show notes. So go grab that, go back and listen to the show again, or, first time around, whatever, but make sure that you've got that printout with you, or it's a pretty big report. So you might not want to print it out. You might have to reload your printer. I think it's about 135 pages in length. In any event, be sure to actually follow along, because I think you'll extract even additional value out of the conversation that we had today. And Kim, just thank you so much for taking the time out of your busy day. And for folks that want to reach out to Kim, learn more about her and her services or company services, they can go to engineeredtaxservices.com. Again, that's engineeredtaxservices.com. We'll also have that in the show notes as well. And guys, that's all I have. Is there any parting notes that you'd like to leave with our listeners before we wrap it up and say goodbye to one another?
I just want to thank Brian and Kevin. Thanks a lot for your business and your support, and for seeing the value of these studies, and for bringing us on the show. And happy to do a follow up later if questions derive from this, and happy to help anyone who has those additional questions as well. So I just want to thank you.
Great.
Yeah, very much appreciated, Kim. And thanks for spending time with us today, not only today, but also over the past several months, and also the last, and also the years to come. But I appreciate you being willing to take some time out of your day to help out all the many thousands of listeners that tune in every week. There's going to be a lot of value provided through the podcast. So it's, again, very much appreciated.
You guys are doing a great service. I'm happy to help.
Well, good deal. Thanks again, Kim. And we'll talk again soon, Brian. Same to you. And that's a wrap. Good deal, guys.
Congratulations! Now you've got more of the best tricks of the trade in building massive amounts of passive income from real estate. For more amazing resources, visit realestateinvestingforcashflow.com, and we'll see you next Monday morning.